Good afternoon and welcome to Freight Forecasting. I'm Michael Vincent, Freight Forecaster here at FreightWaves, and joining me today is Anthony Smith, our lead economist.
That's right.
Thank you for joining me again, Anthony. It's been a while.
Thanks for having me. Yeah, it's been a while. Glad to be back. Glad to be here and on a podcast, Freight Forecasting, with one of the best intros in the game. Love it.
It is, right?
Yeah.
I wish that I could claim that one. I play guitar, but I didn't. That's not my riff. But it's pretty good. It's pretty solid. So. You know, we've been talking about the freight markets and the the pandemic and the panic buying. What'd you call it? Preponomics?
Preponomics.
The preponomics effect on,
right.
On prices, rejects, volumes, etc. Right, and how to utilize different data sets, and specifically within Sonar, to see what's going on and take advantage of different markets and opportunities, or avoid specific hurdles, and see how these fragmented markets are working together, right?
Right.
And if we could show them the screen that I have pulled up on my computer, that'd be great, because I'd like to go through this real quick. So we look at things like this. I've got a market table on the left-hand side, which is giving me my head haul, or the haul index, which measures the outbound to the inbound ratio, inbound tender rejects, inbound volumes, outbound tender rejects, etc. And even break it down in this one, if I move this over a little bit, by van and refrigerated. Right? And break it down by all that. And you can see by the different colors, the reds and the greens, that there's volatile markets all over the place. Right. Even now that we're kind of in this, we're definitely in the trough. We don't know how far down we are in the slope, right?
Yeah, that's correct. I mean, we're on a downturn. I mean, the depth there, it's going to be tricky to kind of call.
It really is. It really is. And you know, on the coronavirus freight market update, we had Ken Sherman, who's president of IntelliTrans, on. And IntelliTrans has been in business for 30 years. A lot of people don't know who they are, but they're behemoth, and they've been tracking freight for a long time in shipments. And what they track is really upstream, right, in the supply chain. It's stuff. It's out of the ground. It's the raw materials that are coming in for production. And he was saying that they saw the big drop over the last couple weeks. Really, it was like 2 weeks ago they saw the drop, which doesn't bode well for those thinking that we're going to come out of this in the next week or so.
Right.
Right. I mean, there's no raw materials coming in. If it's not in warehouse ready to go, manufacturing doesn't have anything to make anything out of.
Yeah.
Right.
Yeah, and that's a good point, because that feeds into a lot. When you're looking at the raw materials, we always look at production numbers, but in order for those goods to be produced, they have to be raw materials available in order for those goods to get produced. And
exactly.
Yeah, and even the hauling of those raw materials feeds into freight volumes.
It absolutely does. So when those orders start to come in, then you'd see the raw materials start to move, and then you'd see the manufacturing, and then you'd see the outcome to the consumer, or business to business, whatever it happens to be, the modes, right?
Right, exactly.
So if we pull back the screen back on, the path I'm kind of going down is, this is very useful information even today, even with the market that we're in today, because even though everything is depressed, we know that the volumes are dropping. We don't know how far they're going down. Rates are dropping as well. And depressed, and we don't know how long that's going to happen. So this is even more vital to your operation and your planning today than ever, because it may mean survival or not survival, finding these opportunities or avoiding these hurdles, right?
Exactly.
So we look at this. Now, another thing that you can do, I'm going to open up another one here real quick, Anthony, is if I look at maritime.
Yep.
So I have another chart here that is coming up, and it should be there in a second, hopefully. Yeah, and so I'm looking at maritime, and this is, I was talking about this earlier today, and I have some things here where, you know, maritime imports to Port of Los Angeles are up 298% since March 1st, and I'm looking at the exports on the left-hand side by origin. These are exports to the United States, or imports, whichever way you want to look at it, to the United States from these specific ports, and they're showing green in most of the major ports. And really over the last few weeks.
Yeah.
So those imports are coming in, but like we talked to Andrew Cox, who is, what is he, our director of research? He's one of our research analysts.
He's a research analyst, yeah.
Research analyst here, was saying, you know, a lot of this is consumer goods and it's going into warehouse. So you can look at this and kind of see that it will affect rail as far as intermodal boxes, right? And then when it hits those destination markets, if you want to call them destination markets, that's really only going to affect the city in real short haul, right?
Sure.
As it goes into, it's not really going to translate into any long haul or tweener volumes until the economy starts to pick back up and people go back to work and start buying and consumer sentiment.
Right.
Right?
Right. Yeah.
So you can look at some of these things and glean a lot of really important information today. But what I want to talk about with you is, how do we know where the bottom is, and what data sets do we need, and are they in Sonar to start looking at this, and what do you compare to start looking at how is this plan taking place that they're working on today?
Yeah, right.
You know, and they're only working on it today, right?
Yeah.
So even if they have a plan agreed to with all the states on how to get the economy back, which how intricate that plan must be, I don't know.
And that's the big thing is that we didn't shut the country down in one fell swoop. It's been shut down in different state by state, depending on the severity of the conditions in the local area.
Right.
Business by business. That was more of a shutdown just of the essential and non-essential, and then not being able to kind of convert to essential products. But it was very much a sectioned off shutdown, and so we're looking at ramping things back up. Going to be very similar. What state can come back online, or what parts of a certain state can come back online, and what businesses are going to start flourishing from there.
Exactly, and we were talking earlier in the week about Mexico and what's happening in Mexico, and it's shutting down and going, and the automotive officials trying to figure out how to time this with the United States, because they're very intricate, the automotive obviously,
right.
And so they kind of have to come back online relatively at the exact same time, right?
Right. Yeah. Yeah. It's a lot of coordination that has to happen, and that's the whole thing with the supply chain, right? It's a lot of coordination that happens. It's a very complex thing, and it's not just if one area is ready to go. You can't just put up a plant. There's a whole operation that has to happen around it, and it gets even more intricate when you start looking at international freight movements.
Yeah. Exactly. And so what I want to do here is I'm going to bring up a blank canvas for us, dashboard for us, and kind of if you'll help walk us through a little bit of what you look at and some of the things that we can compare to try and see, you know, how is this plan working, what sectors it's working in, and kind of what that means. How to use this kind of in a longer range, more broad. How is the absolute market going?
Sure. Yeah.
Does that sound good?
Sounds good.
Perfect. So let me I'll bring up a blank canvas, and if you want to kind of lead me on what you want me to pull up here, and we'll explain what it is.
Definitely, yeah. So I mean, talking about manufacturing, I think the biggest one to go to, of course, is industrial production.
Am I going to chart this?
Yes,
Okay.
we're going to make a chart here,
All right.
and that's going to be iprog.usa, iprog.g.usa.
And so what is that?
So that's going to look at industrial production on a year-over-year level, and this is just got refreshed for the March data. Of course, looking at the data on a macroeconomic level, they are a little bit lagged because March already in April. You know, tons of things have happened since then, but it's useful for being able to dissect what's happening on a different granularity.
Right.
When we're looking at industrial production and different macro data sets. One of the other indices that we were looking at previously last time I was on was non-defense capital goods new orders. So what we can do here is
You want to compare
make
those?
a comparison, yeah.
Okay, so what's the symbol for that one?
That is ORDRG.
ORBRG?
ORDRG.
Sorry. Or DRG.USA?
.NDCGXA.
Oh, there, yeah. And it's filling it out for me.
Perfect. And
So exactly what is that again?
So that's non-defense capital goods new orders, and of course we can put this on the large fonts and dual and all that fancy stuff.
I'm going that way. There we go.
Perfect.
You want me to dual this as well?
Yes, please.
All right.
And so when we're looking at that, of course, if we can look at the full history here, or not full history, but
We go
maybe take it
5
back
year or 1 year?
a
or what?
5 year would be good.
There you go.
So when we're looking at the overall history of it, in the green line, of course, we have, or is that, I think it's green, right? It's green.
It's green.
It's green. All right. get to keep my color blind status here going. Is in that green line, we can see that orders are a little bit lagged in release in comparison.
These are non-defense?
Non-defense capital goods new orders.
Non-defense capital goods. So what are those?
So when we're looking at non-defense capital goods new orders, it's essentially taking a look at capital goods that's not being classified as a defense spending, and this is also excluding aircrafts because defense spending is usually volatile, large swings. We'll see those go up and then drop and go down for a couple of months and up again by a couple billion for a couple of months. And aircrafts, large, pricey purchases, and so these two really kind of sway a lot. So when we exclude those two, we're starting to look at business-to-business activity. And
okay, because this is not consumer goods. These are not toaster ovens and stuff like that, and iPads and so on.
Yeah, these are the big business-to-business activity, capital goods. And so when we're looking at this, although there is a lag between the latest data point is February, we were calling for weakening in manufacturing because we saw a consistent decline in that non-defense capital goods new orders. And so this was one of the points that we were looking at of really starting to point to weakening in manufacturing and business-to-business activity and business investment.
Right, because these are new orders. So this is nothing's moved yet.
Right.
And this is predicting what is going to move.
Correct. And so when we're looking at this, again, it's more tangible. I mean, we're going to look a little bit later at another measure, a popular one that's a little bit less tangible, but is forward-looking. But one of the areas where we're going to start to see some rise, when we do see rise on the other side of this thing, I would suggest keeping your eye on non-defense capital goods new orders, because that's going to really kind of signify, okay, there's going to be some life kind of coming back online, because those new orders go in, it leads to production, then that production leads to shipments down the line, and that all translates into freight volume and business-to-business activity.
So really, until we start to see this green line bounce, if it keeps going down, that just means we're still not at bottom yet.
Exactly.
At least in the business-to-business world.
Yeah, exactly. And as I mentioned, this is a little bit more of a tangible look, but we can look at something that's a little bit more forward-looking. So we can actually replace that orders. You
want me to replace this one, or you want me to switch them first?
Oh yeah, we can replace orders and just keep industrial production up there.
Okay.
And go into ism.m new.
ism.m new?
Yes.
Okay, so what are we looking at here?
So this is a popular measure, the ISM PMI. So the Institute for Supply Management is a popular survey. It releases once a month. And essentially it's manufacturers throughout the US, and they really gauge their outlook and what they're seeing within their neck of the woods for each component of the manufacturing economy. And so when we're looking at the ISM PMI, it's looking at usually management production for the industrial economy. And so it's different components. And so we have new orders, we have production, we have backlogs, we have employment, we have inventories. The latest number for the PMI was a little bit higher than people expect. I think it was in the high 40s, like 49 or 48 or something like that.
Okay.
And that was much higher than people expected. And a lot of that became up for supplier deliveries because there was such a pull forward for so much of the panic buying.
Oh, okay.
And so that really kind of inflated the number. But the area that really felt that's going to be really telling is going to be the new orders area. And so we have manufacturers' new orders from the ISM. And that is going to have a little bit more of a forward look to actually what's happening in manufacturing.
So the previous one we were looking at was, and I forget the actual ticker symbol, but it was non-defense capital goods orders.
Yes.
Mm-hmm. Right? And this one is manufacturing new orders.
Correct.
What's the difference? So
the previous one is released by the government, and so that's a public data set that's available and everything like that. The ISM is a private release, and that's a survey-based indicator. And so the new orders from the government-based, those are estimates from actual transactions of new orders.
Okay.
This one from the ISM, this is more based on surveys, and so it's not as tangible.
Okay.
But as we can see through the correlation, there is a very real-world meaning for the new orders coming in.
So because it's a survey, is it more predictive?
It is a little bit more predictive because now it's starting to get into we already have the data for March here. And
Right.
so next update is going to be through April, and we're going to get that before we get non-defense capital goods new orders. And so when we start to see that the correspondents are getting more new orders coming in, that's when we can start to expect that there actually is some kind of momentum building up when they start to see something happening in their neck of the woods.
So would you look at this, the ISM manufacturing new, and then kind of validate what you're thinking through the non-defense goods?
Yeah, so just as you mentioned, I think earlier on in freight forecasting, is that you have to look at multiple points.
Right.
And so if I start to see a tick up in non-defense capital goods new orders, but I'm also seeing that there's downward momentum in the ISM. But if I'm starting to see both either move up or move down in unison, okay, now I'm starting to see some consistency here.
So
now,
they're supporting each other.
right.
Lends a little bit more credibility to what the trend is.
Correct. And the final kicker, of course, looking at freight data, seeing what's actually being moved on the ground, because we're seeing, we can hear, okay, I'm getting a lot of activity in my neck of the woods, in my business, in my silo, but we're not seeing it moved on flatbed. We're not seeing capacity tighten on flatbed. That's very telling. And so when we can see those three things kind of move in unison, that's when I start to get a little bit more optimistic or a little bit more pessimistic about my outlook for certain sectors.
I got you. So is there a timeline between these? I mean, if you're seeing the ISM new or manufacturing new, the manufacturing new orders, the survey, kind of start to tick up, and let's say that is supported also by the non-defense capital goods orders rising.
Right.
When they start to tick up, does that mean we're a month out, we're 2 months out, we're 3 months out, we're still?
Yeah, I mean, it's going to depend on the industry, but typically when I start to see some rise, I expect, okay, this is about 2 months out, potentially 3 months out from actually seeing that on the production side.
Really?
If we're starting to see a sudden ramp up, I can say, okay, that was a huge spike. We might see this in the next month, but if it's been a consistent rise and a consistent decline, I would say, okay, we're probably going to start to see a decline in about a month or two. But these sudden jolts up and down, I think that's a little bit more responsive because we're starting to see widespread conditions.
It is, and that begs the question, to me it does anyway. So when you say, typically when you see it bump, you're looking at 2 months, 3 months out, right? Even if they're supporting each other.
Right.
The support of each other doesn't mean it's quicker, it just means there's more support for the thought that things were going to improve in the next month or three, whatever it happens to be. But now you're talking about historical.
Yeah.
And there's definitely been black swan events historically.
Yeah.
But not like this.
Not like this. Everything just shuts down. Hit the pause button on everything.
Yeah, it's like done.
Yeah.
So does that change your thinking on how to read these statistics or these trends?
It does. So now I would look at a little bit more of a real-time effect or near real-time effect. So if I start to see a sudden jolt up, I would expect that, okay, if this isn't just a segment-wide thing, a particular component or vertical within manufacturing, I'm starting to think that, okay, maybe there's the floodgates have been opened, so to speak.
Yeah.
If I'm starting to see a sudden jolt up. If I'm seeing like just small little variances, it doesn't really move the needle much, but in times like these, we're starting to see large swings. And so Zach Strickland mentioned, times like these, you're going to see either
He's our is he director of market experts?
He is the director of freight intelligence, I believe.
Freight intelligence, okay. Yeah.
And he, when we usually see like localized events, that's when we usually see things like hurricanes, natural disasters, quick drops, quick rises. This is going to be a little bit different. Although if we see any kind of backing behind manufacturing, I think that's going to be telling. So there's been a lot of talk around the economy reopening and what recovery will look like.
So this could look like a V.
Potentially, I mean.
Potentially it could. But then it depends on how the plan shakes out as far as getting back to work. Is it specific sectors? The plan could be working beautifully, and this just be making little ticks because it's only this sector, that sector that's coming back on.
Right. And with this is business investment, for what we can see, was weak in 2019. So in order for businesses to feel confident in making investments and business-to-business activity happening, there will likely need to be some kind of incentives put in place in order to kind of spur that activity to kind of get the production going again. And when we look at the consumer side of things, there's going to be, even if we are getting imports in from China, if there's not any kind of demand on the consumer or business side, those warehouses are going to fill up, and it doesn't matter if everyone else is back online. If there isn't any demand for any goods, it doesn't really move anything.
How quickly does the plan to reopen the country, how quickly does that get the 22 million people that are now sitting at home back to work, and not only back to work, but confident in spending money?
Right, and that's a big thing, because I think the sentiment was definitely hit hard when some people weren't really prepared for this.
Right, so consumer sentiment is another data set that we should be looking at.
Definitely, yeah, and we have that. We of course have the, I think the popular ones, University of Michigan.
Yeah.
Don't want to say that in front of you, but University of Michigan puts out a nice sentiment index.
Not offended.
Puts out a nice consumer confidence index or sentiment index. The U.S. Conference Board has one. One of my favorites is actually from Fannie Mae, the Home Purchasing Sentiment Index.
Yeah.
We actually have that in Sonar, the hpsi.usa. And although it's geared around housing, when consumers are feeling confident about buying a house, they're feeling confident about buying other things. So I feel like that is a good measure of confidence as well, in order to kind of gauge what the climate is for consumers.
Now back to the manufacturing side. Was there some other you were leading me somewhere?
Yes. So
before we went off on this other, which I think was really good conversation, but.
So we started off with non-defense capital goods new orders.
Non-defense capital good orders,
we saw that, okay, there is a lag there between the two data sets. Then we moved into the ISM.M new, and that's a little bit more leading, but it's not tangible. And so I think the final step is looking at what's actually being moved throughout the country.
Okay, so what do you want me to do here?
We can look at FOTRI.USA.
Am I going to change this entire chart?
We can replace the ISM.M new.
Okay, okay. So what am I putting here? Flatbed what?
Outbound tender rejection index for the
so
US.
FOTRI?
Yes.
.USA. Okay, so FOTRI is outbound tender rejections, just like we've been talking when we talk about just the OTRI nationally, which is outbound tender rejections, which is all modes. This one specifically singles out flatbed.
Yes.
Right, so this is the flatbed capacity's ability or the carrier's willingness to accept loads.
Correct.
Okay.
Correct. And so before we even got industrial production data or manufacturing updates, me and the rest of the team were looking at flatbed outbound tender rejections, because that's going to be telling for what's happening within manufacturing and construction. And so, of course, those are going to be the two variables that you have to look at specifically when we're looking at this. And so we saw that there was a pretty significant decline in FOTRI, and it never really hit the highs that the reefer outbound tender rejections did, or the high that the van outbound tender rejections did. Flatbed was a little bit more muted.
Yeah, right. It was a flatter curve.
And go figure.
Yeah. Right.
And so that sudden decline, and even more rapid decline than the other segments, really kind of indicated, okay, I expect, of course, with the current environment, a lot of contraction happening here within manufacturing. And until we start to see capacity tighten and rejection rates go up, that's one of the other areas, the key areas of actual real-time actionable data of what's happening within the manufacturing and construction sectors.
Okay, so we've got the tangible, which is the non-defense capital goods orders, actual orders, and they lag a little bit.
They lag
because they actually occurred.
Right.
And then we have the ISM manufacturing new orders.
Yeah, and that's a survey-based diffusion index.
Which is, right, and so that's a survey saying, okay, what are you seeing in new orders?
Yeah, it's forward-looking, but it's not tangible.
It's forward-looking, but you can't, bet money on it.
Right.
But together, the two moving in tandem, up or down, signals a stronger up or down
I would
trend.
call that a checking point. Yeah, look at something's going on here.
So then those, then followed by, you're saying first flatbed.
Yeah, if you start seeing
not van,
movement,
not reefer.
Yeah, flatbed.
Flatbed.
Yeah.
And so because that's overall. I mean, we saw reefer go through the go through the roof.
Right.
Reefer capacity go through the roof, and also van.
Right.
In the spend. But that's just consumer spending, panic buying.
Yeah.
It's not the health of the economy.
Correct. Yeah.
So these three things that we just spoke about, those three, non-defense capital goods new orders.
Yeah.
ISM manufacturing new orders, which is a survey and a little bit forward-leading.
Right.
And then flatbed activity.
Correct.
Those three are the three that you look at as those are my leading indicators. That's what you're going to be looking at right now, moving forward to see, okay, are we coming out of this? Is the return recovery plan working?
Correct.
Gotcha.
And there's so many great points that you can make from each one of those things. And so, for example, when you're looking at, of course, everyone out here, it's hard, right? You know, it's bleak across the board on a lot of these industries. It's going to be very pivotal to analyze each vertical that you could possibly be active in. And so we're looking at industrial production, for example. Really across the board, it was down. But if you start looking which is less down or which might be popping up a little bit. For example, although the report was essentially down across the board for the latest month of data, although it's volatile, but defense spending is still above year-ago levels. And so defense spending, if you can negotiate some defense spending contracts potentially to haul some goods on that side, that would be an excellent area to kind of infiltrate. If you can kind of start to see, okay, wood products or chemicals or machinery goods or appliances, things like that. Look at different verticals to kind of see where opportunities might lie and then how you can navigate within those certain sectors.
Yeah, right. So I mean, we've got that data. You need to be looking at that data.
Right.
The truckload data, like we were talking about. So kind of to wrap this up, right? The truck volumes, reefer, flatbed, et cetera, the O-Tri by markets, definitely useful. It's very tactical right now because of the situation that we're in. Right. I mean, normally you could use this as a seasonality, et cetera. It's very, very useful.
Right.
Right now, what you need to be doing for freight forecasting and figure out what's moving, what's going forward, is you need to be looking at these economic indicators here to really decide how is the plan going, where to move, and going into those different verticals to try and find those opportunities in those niche markets or different verticals.
Right. Correct.
Right?
Correct.
Excellent.
Thanks for having me.
Hey, Anthony, it's always a pleasure, my friend.
Definitely.
Very insightful.
Oh,
very insightful. So hopefully you learned something here today with where we're at and how we're looking at this and how Anthony Smith, our lead economist here at FreightWaves, is looking at this and trying to gauge where the trough is, where it bottoms out, and how well the plan and recovery is. It's essential to be using multiple data sets and have a good plan on how to utilize those so that you're not comparing two things and trying to forecast, and it's really just a, what do you call it, a spurious correlation?
Yeah, a one-off event potentially, yeah.
Yeah, that doesn't mean anything. So non-defense capital goods orders.
Yep.
The ISM manufacturing new orders.
Correct.
And then flatbed rejections.
Yep.
Those are the three keys.
Yeah, definitely.
Thank you so much, Anthony. Appreciate it.
Thanks for having me.
So thanks for watching, and hopefully we'll see you next week, 4 p.m. Thursdays. Freight forecasting. I'm Michael Vincent. Peace and love.